Bottom line up front, I got paid roughly $400 in dividends year to date in my Fidelity account. In this video, we're going to talk about dividend stocks and dividend investing. I am also going to share with you which companies or stocks paid me and how much. For demonstration purposes, we will only be using earnings from the Fidelity account, but most of the companies that paid me are roughly going to be the same ones that we have in the YouTube portfolio video right here or here, I think. Welcome back to the channel, and if you're new here, this is Super Savvy. Over here, we talk about any and everything finance related. So, if you like the idea of receiving payments either monthly or quarterly from the companies you invest in, please hit the like button and subscribe to the channel so more people can follow the journey. As always, this is not financial advice. Please do your own research to make an informed decision. I am just a regular 9-to-5 guy who's trying to share the little I know with the community. And with that out of the way, let's get right into it. And then there are dividend stocks. Dividend stocks are shares of companies a portion of their earnings as a shareholder on a regular basis. Usually quarterly, which is every 3 months, but some also pay you monthly. Payments now and not your friend said dividends. Companies are dividends no. They tend to be more established and financially stable. For example, companies say Coca-Cola and Johnson & Johnson use dividends as a way to reward you for investing in their company. Now, how do you know if a stock has a good dividend? A way to find out is by looking at the company's dividend yield, which is the annual dividend payment divided by the stock price. For example, if a company pays you $4 per share annually and its stock price $100, the dividend yield 4%. A simple way I'll be to check it by using your brokerage app. So I'm going to use the company O Realty Income Corporation as an example. So let's go into the YouTube portfolio and then click on the O Realty Income stock profile. Now let's scroll down to the stats section, click on view more to get more information. Now over here, what we care about for the purposes of this video is the annual dividend, which is $3.15, and the dividend yield, which is 6.02%. Now that we've collected the information we need, let's do some simple mathematics. So we said the annual dividend is $3.15. So we're basically going to divide that by 12, and that gives us 0.26. So basically 26 cents. Now, you're going to say you bought 60 shares at the current stock price of $52.92 per share. We're basically going to multiply 60 shares by 0.263, and that gives us $15.78 every single month. So for investing roughly $3,200, which is approximately the cost of 60 shares you get paid $15.78 every single month. In my retirement account, for instance, I have roughly 60 shares of this stock, and I receive $15 every month. The cool thing about ASA, you can choose to reinvest that $15 back into buying more shares, which will over time increase your positions and essentially increase the monthly payment. And now I said you can choose to withdraw that $15 now every month to buy whatever you want or pay whatever $15 bill that you have every month. This concept is why I believe the rich keep getting richer and the poor keep getting poorer. So let's say you have $50,000, and after you've done your due diligence about the company that we're using in this example, you decide to invest that $50,000 into O Realty Income Corporation because it pays a monthly dividend. Now, that $50,000 will buy you roughly 945 shares of O Realty. And by doing the math, 945 times 0.26, it will give you an amount of $248. Now that can pay for your monthly insurance bill and probably your cell phone bill. Or you can simply reinvest that $248 back into buying more shares, which will over time increase the monthly payout. I hope that makes sense. That was just an example, by the way. And as a word of caution, do not invest in a stock solely based on its dividend payout. As always, do your research, look at the numbers, check your trends, making sure you understand what you are investing in so you can make an informed decision. Now, here are 3 main reasons why you should consider investing in dividend stocks. Reason number 1, a passive income. Dividends, it provided a steady stream of income, particularly for more planning for retirement. And I say anybody that's looking to supplement their monthly or annual income. Reason number 2, the potential for growth. Now, a lot of dividend paying companies, they have a history of consistent growth. And by reinvesting your dividends through what we call the DRIP method, which basically means dividend reinvestment plan, you can compound your returns over time. Reason number 3, stability. Kai said, good dividend paying companies, they tend to be less volatile. And now they can provide you more stability in your portfolio, especially when the markets are down. For instance, your be dividend aristocrats. Dividend aristocrats, are basically a group of companies in the S&P 500 or increase your dividend payouts for at least 25 consecutive years. And they have historically outperformed the broader market with less volatility. And usually the amount for extra dividend stocks to invest in, I'm gonna check is the company part of the dividend aristocrats or not. Now, if you want to find out if a stock that you are researching is part of the dividend aristocrat list, you can simply just Google dividend aristocrat list for the current year and then check. Now, how do you choose dividend stocks? When you're trying to choose dividend stocks, here are some factors you should consider. Number one, the dividend yield. The dividend yields will tell you how much you will earn in dividends in relation to the stock price. You have to be cautious when the dividend yields are too high because that might not be sustainable. Number two, the payout ratio, where the percentage of earnings paid out to you as dividends. So a lower payout ratio basically means that the company has more room to maintain or grow its dividend. To break it down further, the dividend payout ratio shows you how much of the company's profit is given to shareholders as dividends versus how much is kept to grow the company. So if the payout ratio is higher, it means that the company is paying out most of its earnings as dividends. Say a lower, that means that the company is keeping more money to reinvest back into the business. Number three, a dividend growth history. Share companies are more a track record of steadily increasing their dividends. The dividend growth ratio ever show whether the company has consistently increased and as a decrease or even maintained its dividend payouts. Way an indicator of financial health and also commitment to returning value to shareholders. Number four, the company's fundamentals. Always try to check the company's financial health. Some good signs to look out for strong earnings, manageable debt, and a competitive advantage. Wait me check this animal by looking at the company's income statement, or more balance sheet, or more cash flow statements, or more profitability and liquidity ratios, and or more price to earnings or PE ratios. There's a plethora of metrics you can look out for. Now, using the company Johnson & Johnson as an example, Yanko NASDAQ.com. Now I type it in the ticker symbol J&J. Now I click it on dividend history. Now I bet you I'll say this company will show a solid history of dividend payments and growth with a reasonable payout ratio. And going through all these tabs, you would see it has strong fundamentals. Now, make this company a popular choice for dividend investors. You can spend more time doing some digging on your own. Now, let's talk about some strategies for dividend investing for the current year. Strategy number one, to focus on dividend growers. Companies that consistently increase their dividends, they often have a strong business model and strong financial discipline. Your companies are almost show these signs, they are going to continue on that trend and also on that path. Number two, to diversify your holdings. As I always preach, spread your investments across different sectors to reduce your risk. Even though industries, which is the utility industry, are known for their dividends, may overlook other industries, which is tech and healthcare. Number three, to consider international dividend stocks. All right, global diversification, everything I expose you to higher yields and different economic cycles, right? So companies are more emerging markets, for example, or more most of the time, so they can offer you higher dividend yields. Number four, to watch out for interest rate changes. Dividends can become more attractive in a low interest rate environment, right? But rising rates, might shift investor preferences. So try to stay informed about the macroeconomic trends. I know. Nobody has time to do that, but you just got to do the research, man. There's no way around it. Just do the research. Keep up with the trends, and you'll be good. Number five, to reinvest the dividends. Now, using the drip method near use that to reinvest the dividends automatically. Now, this can compound your returns, over time. Most brokerages, may allow dividend reinvestment so automatically, and ever save you time and the headache to manually reinvest, right? So if you're a long-term investor, this strategy is perfect for you because you are not worried about checking it every single month. You just click a button, and then every dividend that you get gets reinvested back into the company. Now, with the current economic uncertainty and fluctuating interest rates, having a balanced approach to dividend investing is very important. So we're talking combining growth and stability while keeping an eye on the global opportunities, can enhance your overall portfolio's performance. Now, let's talk about the potential risks of dividend investing. Risk number one, dividend cuts. It's a company and as a stock now or investing in. If they face financial trouble, it may reduce or eliminate the dividend totally, which may impact your income and possibly the stock's price. Number two, interest rates risk. Rising interest rates, can make dividend stocks less attractive compared to things like bonds and other fixed income investments. Number three, economic downturns. Now, dividend paying companies, they might struggle during times of recession, which may lead to potential dividend cuts and again, decrease stock prices. Number four, sector concentration. Men rely too much on a single sector, which is utilities and asset real estate, because this can increase your risk. And if the sector that you are concentrated in faces challenges, you're in trouble. And for example, during the 2008 financial crisis, most companies, including financial giants, were forced to cut dividends. And being diversified and keeping a close eye on your holdings, can help mitigate your risk. And also, I understand if you don't feel comfortable investing in a single dividend paying company, so you should consider going the route of dividend ETFs. Dividend ETFs, exchange traded funds, it focuses solely on dividend stocks for instant diversification and professional management. Now let's go through the companies or stocks that paid me from January to now and how much they paid. I have 3 accounts in the Fidelity portfolio and I'm going to go through each account. Okay, so for the first account, January 16th, OXY, Oxy paid me $3.82. January 31st, SPACs paid me 3 cents. February 6th, BND paid me $1.15. February 29th, SPACs paid me 2 cents. March 6th, BND paid me $1.10. March 25th, SCHD paid me $42.62. March 27th, VOO paid me $11.12. March 28th, SPACs paid me 7 cents. April 4th, BND paid me $1.17. April 15th, Oxy paid me $4.67. April 30th, SPACs paid me 19 cents. May 6th, BND paid me $1.16. May 31st, SPACs paid me $5.49. June 8th, BND paid me 6 cents. June 26th, XLE paid me $15.43. June 28th, SPACs paid me 9 cents. And June 26th, XLE paid me $15.43. June 28th, SPACs paid me 9 cents. And then July 1st, SCHD paid me $147.78. As you notice, the dividend payout keeps increasing over time. That's due to the fact that I am reinvesting the dividend payouts back into buying more shares, or I am manually increasing the positions myself by monthly contributions. Okay, so we're going to go to the second account. January 12th, O Realty Income paid me $15.01. January 31st, SPACs paid me 4 cents. February 15th, O Realty Income paid me $15.01. February 29th, SPACs paid me 9 cents. March 15th, O Realty Income paid me $15.01. March 28th, SPACs paid me 14 cents. April 1st, SPACs paid me 2 cents. April 2nd, SPACs again paid me 2 cents. April 5th, FXAIX paid me $7.02. April 15th, O Realty Income paid me $15.04. April 30th, SPACs paid me 79 cents. May 15th, O Realty Income Corporation paid me $15.04. May 31st, SPACs paid me 1 cent. June 14th, O Realty Income paid me $15.43. Now, as you can see, I have SPACs in different accounts. So SPACs is not a company or a stock that I actually invested in. So with Fidelity, once you have uninvested cash sitting in your account, they automatically allocate it to SPACs so you can earn on your uninvested cash, if that makes sense. Moving on to the third account, year to date, March 15th, VTI paid me $11.91. June 21st, VTI paid me $29.45. June 28th, VTI again paid me $8.03. I'm not sure what happened here. I probably either sold some of the positions in VTI, and that's what probably caused the drop, or they made the payments, they made two payments. They probably made a mistake with the first payment, and then they sent the supplemental payment. That's probably what happened. I have to look into it. So when you sum all that up, that totals an amount of $399.73. So basically, $400 is what I've been paid in dividends year to date in the Fidelity account. I hope that would help put things into perspective. Over time, I hope to have a substantial amount that will supplement or replace my monthly income or even my annual income. If you found this video helpful, please give it a thumbs up and subscribe to the channel so more people can follow the journey. That's it. That's it. Yebishia.